Hello.
Money. At some point in every negotiation, how much a product or service will cost must be discussed. We agree that to avoid a commodity-type price negotiation, it is important to establish a price-value relationship during the buying cycle. Another premise is that people assign value to make decisions based on a perceived benefit to gain or a loss to avoid. And selling history proves that people are 3 times as likely to buy something to avoid a loss than to realize a gain. This argument is a basis for the whole insurance industry. You pay a premium today to avoid future financial loss. Therefore, 2 major elements of value are uncertainty or risk and time. Minimizes the risk. We didn't pay that much, so if it doesn't work, we aren't out a lot of money. This argument is not valid because not losing much money is only one of the consequences. Other consequences of a failed implementation might be loss of investment opportunity, taking what little money was spent and applying it to a solution that doesn't work and get results, stakeholders' perception of the decision-maker's business acumen skills, and loss of customer trust. Time is the other major factor in your solution. In a sense, you are saying to a customer, invest money today for either a cost savings or increased cash flow in the future. Here's a way to prove those future cash flow dollars. First, become familiar with financial language. PV is a present value of money, either dollars or the currency of your country. FV is future value of money. $1 today is worth more than $1 tomorrow. N or NPR is a number of periods of the expected return, usually measured in years. R is interest rate or opportunity rate. Most organizations have an internal rate they use to measure investments. Here is how the investment looks on a timeline. You can determine the net present value of an investment using Excel function, FX, formula bar. It makes the calculation of the value of the investment easy to calculate and explain. Here's an example, and I'll show you some screenshots. Let's say your solution will cost $1,000, and at the end of the first year, the customer can expect a savings of $1,320. And at the end of the second year, can expect a savings of $1,452, with a rate of return used by your customer of 10%. On an Excel sheet, in A1, put the investment as a cash outlay, in this example, of minus $1,000. In B1, put the anticipated cash flow or savings at the end of the first year, $1,320. In C1, put the anticipated cash flow or savings at the end of the second year, $1,452. In the formula bar, enter equal sign and then the letters MPV, which stands for net present value. For rate, in this example, enter 0.1 for 10%. For the value, enter B1:C1 for the 2 years. Put a closed parentheses, a plus sign, then click on cell A1 to enter the investment cost. The net present value of the investment will appear in cell A2. So the value in present value dollars of the investment is $1,400. Go to the Everest Training website for more tips on how to use financial acumen to close more deals.